All right, good day to everyone from everywhere you might be listening to me. Welcome to another session of tutorials. We shall be looking at IS 40, and that is investment property. This is also one of the standards you need to know as an accountant or anyone preparing for ACCA or ICANN financial report examination or corporate reporting, as it were. It's one of the standards that you need in preparation of certain investment property in under your statement of financial position. You know, when you go to under your statement of financial position, the line items basically that you always see there are PPE, which is property, plant, and equipment. It has its own standard that covers it. And then we have intangible assets. It's also there. That is also covered under IS 38. And then we have investment property as well as financial assets. So all of these are also under your statement of financial position. So let's really look at this standard also, investment property. It's one of the standards that you need to know, like I have said. Please, just let's run through it. It's a simple standard too. I will tell you for a fact, for a truth, it's a very simple standard. So just take your time, listen to me and follow me by what I have to tell you. Now, what it is just as the name sounds, investment property. And investment property simply means that assets, that property that is being held for the purpose of, earning what we call rental income, or for the purpose of capital appreciation, or both put together. In other words, simply put, they are properties that are being held for investment purposes. For what? Investment purposes. In other words, you are holding it, and for every investment that you are engaging yourself in, you are expecting what we call a return. And so the returns for an investment property that is being held by an individual or an entity are known as the income from rents. Or you are holding the land for capital appreciation, the income from capital appreciation, or both. Now let me give a very good example, a solid base example. When we talk about an investment property, you buy a property. You keep it you bought it this year, the year maybe let's say 2022. You now keep it until year 2024. You now went back to that property, revalue it. You bought it back then 2 years ago, maybe at 20,000 naira. You went these 2 years afterward to revalue the land. The land is now 25,000. That is what we call capital appreciation. Or take for instance, you bought a property, you now converted it for rent. That rent income that you are earning is also a return on your investment, and that is just a simple definition of an investment property. So when we talk about investment property, please understand this: it is an underlying asset that is being held to earn renters or for capital appreciation, or both. That is, the two together, either rent for renters purposes to earn money from rents, or for capital appreciation, or both together. It's as simple as that. You don't need too many to but you need to understand this. You need to understand this definition. It's very, very important. If you don't understand this definition, you can't proceed with investment property. So when we talk about investment property, it is different from property that is being used in ordinary course of the business. The properties that you are using, for instance, in ordinary course of business, is being treated under IAS 16 under PPE. But for investment property, you are not using it to do any business. You are not using it to trade. You are not using it to do anything. Take for instance now, you bought a warehouse in Lekki. Or you bought a house, let's put it this way. You bought a house in Lekki. You convert it to a warehouse where you do distribution to other West African countries. Can you classify that property as an investment property? The answer is no. Why? Because you are still using it in the ordinary course of your business. Remember, you bought the property, you converted it to a warehouse, and then you are now selling it. You are using it to, distribute your goods to other West African countries. You are still using the building. But take, for instance, you bought the house in Lekki this year. You kept it there. You went back there a year after and discovered that the value of the house has increased. That is what we call capital appreciation. You bought it, you kept it, you are not using it for any purpose. The reason why you buy it is that the value of the property will increase. That is what we call investment property. However, also understand this, that investment property do not apply to properties under lease. That is IFRS 16. Investment property do not apply to properties under lease. Lease property have been treated under IFRS 16. And why is it so? If, for instance, I have a building, I bought a building now, and this building I'm not going to use it for any reason. Somebody now approached me and said, please, Oga, lease this building to me for 5 years. I'll be paying you this amount of money. Now, understand this. For you to recognize an asset in the financial statement, it must meet the criteria. What is the criteria? What is the criteria? The criteria of control. That is, an entity must have control over the use of the asset, and that control must result in what we call generating future economic benefits. You must use it in the ordinary course of business to generate future economic benefit. Now, once you lease your property, once I lease down my property to that individual that came to plead with me, it means that I have lost control for good 5 years. Because the person I'm leasing it to now, let's say for instance the person is into productions, the person will be using that asset in the ordinary course of the business. And that is why that kind of property cannot be classified as an investment property. It is as simple as that. So that is that for that. Key definitions. I've just given you the definition. Property held for sales. Property held to earn rentals or capital appreciation or both are known as investment property. So understand that investment property is different from owner's occupier property. Owner's occupier property. For instance, government build a house and say people should come and be staying there. That government house that is being built and people are staying there, they are not investment property. For instance, you can't buy that house and keep it there and say you are not using it. Or you can buy it and keep it there. That is an investment property. If, for instance, they build it now, they now give it to you, and that you should be paying certain amount of money back. That's owner's occupier. You'll be paying, or they will be removing certain amount of money from your salary and the likes. That's owner's occupier. So it is different from an investment property. That is classified and being treated under IAS 16. If you have not watched our video on IAS 16, please do and watch our video on IAS 16 so that you can understand what it is all about. So that is that for that. And so quickly, let's go to the recognition and the measurement criteria. Investment property is recognized as an asset when it is probable that the future economic benefit will flow to the entity and that the cost can be reliably measured. That is the recognition criteria. Two things are key for you to recognize an investment property in your statement of financial position. Two things are very, very important. Number one, you must be able to ascertain that it is highly probable that there will definitely be a future economic benefit that will accrue to the entity. In other words, the renters, they are future economic benefits. Capital appreciation, they are future economic benefits. So that must be highly probable. Take for instance, you went and buy a house in a war zone or where the war is currently going on, and the value will keep going down, until the war finish. That's not an investment property, as it were. An investment property should be that you are certain that there will be a future economic benefit from you investing in that property. That is number one. Number two, the cost must be reliably measured. It is not that we cannot ascertain the cost at which you used to, get the property as it were. Take for instance, you bought a land, you build a house on top of it, you give it out for rent. That is an investment property. Why? You are not using it and to trade. You are not using it in the ordinary course of your business. But there is also a clause to this. What about the people that are building estate and selling? Are we going to call that house and the building and the land as an investment property? No. Why? Because that is their business. That is their own business. The real estate people, they are the one that bought the land, they build the house, they sell it to people. That is their business. So the houses and the land that they are buying and selling, they are their own inventory under IAS 2 inventory. That is their own inventory. Please understand it. Don't get confused. But if you buy a house and, as an individual, you keep it or you give it out for rent at a commercial prices, you give out for rent at the commercial prices, that is an investment property. Now, this also makes me to remember something now. If you are giving out a house for a rent, the amount that you are giving out as rent, the amount you are receiving as rent from that property must be equivalent to the commercial substance, the commercial value of, the rent that is prevalent in that location. What I'm saying is this. If, for instance, you stay in Lekki, house rent in Lekki are, let's assume, 1 million naira. You know that. You are now giving out your own house at 500,000 naira. You are not doing well. I will tell you for a fact, you are not doing well. So, understand this. You are not, giving out the property at a commercial value. It is lesser. Once it is lesser, you can also not classify that property as an investment property. Rather, we look at it as you are doing charity business. You are doing a charity business. So, understand this. It is very, very seamless, very, very simple. If you have this understanding, you can always maneuver IS 40 as it was. So, investment property is recognized as an asset when it is probable that the future economic benefit will flow into the entity and the costs are reliably measured. That is that for that. So, quickly let's go to measurement. Investment property is measured initially at cost. Please note that. You measure investment property initially at costs. That is very, very important for you to note. We measure investment property at costs. That is first. And then subsequent measurement can either be by, using what we call the fair value model or the cost model. Either use the fair value model or the cost model. It's as simple as that. The initial measurement, that is your year one measurement, is at your historical cost. How much did I spend to buy the land? How much did I spend to build the house? All put together, the transaction cost, the legal fee, the provisional fee, everything put together, it becomes the cost, the historical cost attached to that property. That is the initial measurement. And the subsequent measurement is the year 2 and above. That is subsequent measurement. Now, what is the current value of that investment property? How do you determine it? It is by using either the fair value model or approach or the cost model approach. The cost model approach simply means the historical cost less accumulated depreciation. You get the value, the net book value. But if you don't want to use that approach, according to IS1, they give us the privilege of either using the cost model or the current value model. So you can either choose to use the fair value model or the cost model. So if you choose to use the fair value model, what you need to do is to get the market price of that asset, compare it with the current amount of the asset, and then if there is any gain, that means the asset have appreciated. you recognize what we call revaluation gain. Just the way we do it under PP, you recognize revaluation gain. And if there is a loss in value, you recognize impairment. Then the same way we treat it under IAS 16 is the same way you treat it now, or the same way you treat it under IAS 36 is the same way you treat it. Take the loss, so it's not a profit or loss account. It's as simple as that. So you can be asked, how do we value in subsequent measurement of investment property? You can be asked. It's as simple as that. So please, you can value that using the cost model or the fair value model. Now, the fair value model is always very seamless. Your fair value, that is the market price less cost to sell, will give you the actual current value of an asset. It is important to always remeasure your assets. It is very, very important to always remeasure, especially your non-current assets. It is very, very important for you to always remeasure. Why? So that you will keep the asset in the asset, or those assets that you are putting in the financial statement will be faithfully represented. You are giving out what is called a up-to-date information. You know, when I'm teaching, I don't like using those technical terms. I want to bring it out to your level. As a layman, you understand it logically, you can put it down. And so follow me as I'm going about it. So you must always do what we call subsequent measurement. The belief is there will always be changes in prices, changes in because of changes in inflation, interest rates, changes in technologies, changes in government policies. This always will bring about changes. And so therefore, as an entity, you must always remeasure your asset to make sure that your asset is up to date. You understand? Whether it is devalued or appreciating, you must be able to ascertain and measure it. That's why we are using those subsequent measurement basis of either cost or the fair value approach. So that is that for that. It is important, however, to always revalue your asset. That is that for that. So quickly, let's run through some questions now, and then that will help our understanding. Question 1. Which of the following is a characteristic of an investment property? Which of the following is a characteristic of an investment property under IAS 40? A. Asset that is held for use in production or supply of goods and services. B. Asset held to hand renters or for capital appreciation, or both. C. Asset held, that is investment property, held for sale in the ordinary course of business. And D. Held for administrative purposes. Which of them best suit the definition of IAS 40 investment property? I'm sure you know the answer, or I should give you the answer. The answer is held to hand, that is B. Held to hand renters or for capital appreciation, or both. That is that for that. So now let's go to question 2. Under IAS 40, investment property can be measured using which of the following model? Investment property can be measured using which of the following model? We have A. Cost model only. B. Fair value model only. C. Either the cost model or the fair value model. And C. Both the cost model and the fair value model. Now, there was a day I was teaching this very particular standard, and I asked my student this question too. Now, that was why I brought it down. Now, I asked them, which model do you use? And I mean, a lot of them choose D. They say both the cost model and the fair value model. The answer, that answer is wrong. You can't use both. You can't use both. According to the standard, you either use the cost model or the fair value model. From IAS 1, we have been told you cannot use the two together. And you must be consistent. That is where we have the principle of consistency. You must be consistent with whichever policy that you are adopting. It's as simple as that. Thank you. So let's go to question 3. What is the definition of investment property? I'm sure you know that. And so I'm just bringing all of this so that we can use it to, quicken our brains. And that is very important. Very, very important. So question 4. What are the two measurement models? We have discussed that. And then let's go. I want us to see question 7. And then we call it, it's very simple. This is the most simplest standard. To me, I feel is the most simplest standard. So let's look at this question 7. ABC company acquires a building for 10M with the intention of renting it out to tenants. The building has a useful life of 20 years. And then ABC company chooses to measure the building using the fair value model. At the end of the first year, the fair value of the building is 11M. What is the gain or loss recognized that should be recognized in the income statement? What is the gain or the loss that should be recognized in the income statement? Quickly, let's go to the answer. Now, let me take you back a bit. Look at it now. They said, acquire building for 10M, the intention of renting it out. By this renting it out, it means they have met with the criteria of any future economic benefits. And also, that is number one. Please note that. The cost can be reliably measured. They have told us is 10M. So they have met with the criteria of classifying this asset as an investment property. But look at it this way. They said the building has a 20 years life. And as at the end of the first year, the fair value model was to be used for subsequent measurement. And then they got the fair value of the building to be 11M. Is there a gain or a loss? From here, you will know that there is a gain. Why? Because the current amount of the asset is 10. The fair value is 11. So there is a gain. So how do you treat this gain? How do you treat it? It's as simple as ABC. This gain is known as your revaluation surplus. Revaluation surplus. So you take this revaluation surplus to your OCI. Under your OCI, you put it there, revaluation surplus, revaluation gain. And when you are doing your schedule, you also do the schedule and recognize your revaluation gain as it were. Why? Because you have to carry this asset. You understand? You have to carry this asset at this new fair value price of 11M. So what do? I want you to write it in the comment section. What will you do? Where will you debit and where will you credit? Write it in the comment section. Very, very important. Thank you. So let's go. Question 8. Deaf company acquires a property for 5M. Intention of holding it for capital appreciation. You see, the property is measured using the cost model. At the end of the first year, the property carrying amount is 4.5 due to depreciation. The fair value of the property at the end of the first year is 6M. What disclosure is required under IAS 40? Now let's look at this disclosure together. Disclosure requirement. That is also disclosure requirement. Number 1, an entity must disclose information about their investment property. Very, very important. An entity must disclose. They must disclose it. Very, very important. The information about their investment property. That is number 1. Number 2, they must disclose the method that is used to determine the cost, the initial cost of the investment property. Number 3, they must disclose the method that they adopt in subsequently measuring this investment property. That is number 3. Number 4, if they have chosen fair value model, they must be able to tell us the observable market data. The observable market data. And that is that. And then they must be able to reconcile the fair value with the current amount to determine if there is a loss or a gain. That is that for that. See that this standard is very, very simple. It's the most simplest standard. I will tell you for a fact. It's very, very simple. So, like I said, in summary and in conclusion, investment property held under lease should not be recognized and measured in line with IAS 40. It's different. It's being treated under IFRS 16. I'm just stating this now. Equally, assets that are related to agriculture, you can't classify them as investment property. So therefore, please understand that investment property IAS 40 is so seamless. All that you need to know is the definition. What is it all about? How do you recognize it? how do you measure it, and how do you treat it? And that is what we have looked at in these few minutes that we have spent together. By way of summary in the next few seconds, investment property, they are property that are held for earning renters or for capital appreciation or both. Simple. Recognition criteria. Number 1, it must be ascertain. You must be able to ascertain that there will be a flow of a future economic benefit. And number 2, the cost associated with this investment property must be reliably measured. You must be able to ascertain it. That is number 2. And then we go to measurement. And we said that for you to calculate the value of an asset, the value of your investment property, initially you measure it at the historical cost. That is the cost at which that investment property was gotten. That is number 1. That's for year 1. And then for year 2, upward, which is subsequent measurement, you use what we call either the fair value approach or the cost model approach. The cost model approach is historical cost less your accumulated depreciation, while the fair value is that you are comparing the current amount of that asset with the market price at arm's length. That is what we call fair value less cost to sale, as it were. It's as simple as that. It's not more than that. I'm sure you have been able to add value and knowledge to yourself. Please comment and share these videos as many as you can, and as well subscribe to these channels. Thank you one more time for listening. If you have any question, put it in the comment section. We will attend to it. Have a very wonderful time.